In recent years, about 62% of Americans have money in the stock market. If you look at the S&P 500 index, it has nearly doubled in value over the past 5 years. You might think that would mean everyone is getting wealthier, but that isn't the case. In fact, the opposite often happens. Within financial circles, there's even an unflattering term for the average investor: capital donors. This is because around 75% of everyday people who invest in the stock market actually lose money over time. Their capital essentially ends up enriching those who are already wealthy. Today, the wealthiest 10% of Americans control nearly 90% of all stock market wealth, showing there's a huge difference between the way ordinary people invest and the strategies used by the rich. To understand how the wealthiest investors achieve such consistent results, it helps to first look at how the average person invests in stocks. The reality is that most retail investors, everyday people buying and selling stocks on their own, eventually lose money. They often believe they can outsmart the market by picking the right stocks, timing trades perfectly, or following the latest buzz from strangers online. But stock picking is harder than it seems. Many buy shares when excitement and optimism are high, only to sell when fear sets in and prices drop. This habit of buying high and selling low is exactly why many on Wall Street label them capital donors. That said, not all retail investors lose money. Some approach the stock market with discipline, patience, and a long-term mindset, and they do manage to build significant wealth. The most reliable starting point for a new investor is often with blue-chip stocks. These are shares in large established companies with global reach and a proven history of surviving economic downturns. Think of companies like Apple, Microsoft, or Coca-Cola. These firms might not deliver dramatic short-term gains, but they tend to be steady performers that pay dividends and grow steadily over time. The winning formula for this approach is simple: buy, hold, and let the investment compound over years or decades. If, for example, you had bought Apple stock 5 years ago and simply held on to it, you would have roughly doubled your money by now. However, investing all of your money into one single company carries risk. Even the most reliable corporations can face scandals, poor performance, or changes in the market that hurt their share prices. To reduce that risk, many investors choose to spread their money across multiple companies. This is where index funds and exchange-traded funds, ETFs, come in. These allow you to own tiny portions of hundreds or even thousands of companies at the same time. Many people access these through retirement accounts such as 401ks or Roth IRAs, which also offer tax benefits. Like blue chip investing, the strategy here is straightforward: buy, hold, and let compounding do its work. Index funds are low cost, low effort, and historically deliver strong returns over time, making them one of the most effective strategies available to regular investors. Some investors take it a step further and think about diversification, not just spreading investments among different companies, but across different sectors, regions, and asset types. This could mean holding domestic and international stocks, bonds, and real estate investment trusts, right, REITs. The idea isn't necessarily to chase bigger gains, but to reduce risk. If one sector, say technology, drops sharply, another sector like healthcare might hold steady or rise. If U.S. markets slow down, international investments might perform better. This kind of diversification smooths out the ups and downs of the market, creating a more consistent long-term return. For many people, diversification combined with blue-chip stocks, index funds, and ETFs is as far as their investing journey goes. But that's not the case for the wealthy. The richest 10% use far more sophisticated and powerful strategies. Interestingly, one of the first moves that millionaires often make is the same one that causes most small investors to lose money: picking individual stocks. The difference is in how they do it. Wealthy investors aren't chasing the latest social media hype or trying to flip stocks quickly. They take a strategic, research-driven approach. Some follow value investing principles, seeking companies they believe are undervalued compared to their true worth. Others search for companies with explosive growth potential before the rest of the world notices, essentially trying to find the next Amazon before it becomes a household name. They pore over company fundamentals, earnings reports, and long-term industry trends before buying. Even with careful selection, No one can predict the future. That's why wealthy investors focus heavily on not just making money, but protecting it. One way they do this is by using derivatives and hedging strategies. For example, in the late 1990s, Mark Cuban had a large amount of Yahoo stock after selling his company to them. Suspecting that the dot-com bubble wouldn't last, he used something called an options collar. First, he bought put options, which gave him the right to sell his Yahoo stock at a fixed price, even if it dropped dramatically. To offset the cost of those puts, he sold call options, giving another investor the right to buy his stock at a set price if it rose. The trade-off was that Cuban limited his potential profits, but in return, he guaranteed he wouldn't lose money when Yahoo's stock crashed. This is the kind of forward planning wealthy investors use to protect their holdings, whether it's a single large investment or their entire portfolio. Not all strategies are about playing it safe. Some wealthy investors use risk to their advantage through margin and leverage. In essence, this means borrowing money to invest more than you could with your own cash. If you have $1,000 and borrow another $1,000 to invest, you can double your position in the market. If the investment rises, your profits nearly double after paying back the loan and interest. But if it falls, your losses multiply just as quickly. This high-risk, high-reward tactic can accelerate wealth growth, but can also wipe out investments if things go badly. Many wealthy people don't have the time to manage their portfolios in detail. They might be running businesses, managing real estate, or pursuing other ventures. Index funds might be too simple for their needs, so they often turn to hedge funds. These are private investment firms for high-net-worth individuals and institutions, run by professional managers who use advanced strategies to generate returns in almost any market environment. Hedge funds vary widely in approach. Some focus on buying and shorting stocks, while others bet on events like mergers, bankruptcies, or policy changes. The largest hedge fund in the world, Bridgewater Associates, makes massive bets on global economic trends. For example, predicting how interest rates in one country might influence commodity prices elsewhere. Another extreme example is quantitative hedge funds, which rely on algorithms, mathematics, and huge amounts of data to trade. Renaissance Technologies, founded by mathematician Jim Simons, uses such models to execute thousands of trades per day. Their systems look for tiny recurring patterns in market behavior that humans might never spot, such as a tech stock's tendency to dip slightly after a certain type of morning surge, or how weather patterns can affect agricultural companies. These trades happen automatically and with precision, producing returns that have made Renaissance's Medallion Fund the best-performing hedge fund in history. For millionaires, hedge funds are often the highest level of accessible investment, but for billionaires, even hedge funds have limitations. A hedge fund chooses the strategy, controls the risk, and caps investment amounts. It won't tailor an entire financial plan around an individual's broader needs like taxes, estate planning, and generational wealth. That's where the family office comes in. A family office is a private wealth management firm that serves one extremely wealthy individual or family. It functions like having a personal hedge fund, private equity firm, tax department, and legal team under one roof, all dedicated to growing and protecting a single family's fortune. Family offices don't just invest in public markets. They also engage in private equity, which means buying stakes in private companies or entire businesses before they go public. These deals can yield enormous returns, as seen when Jeff Bezos invested in Google. In 1998, Peter Thiel put $500,000 into Facebook, or Elon Musk got involved with Stripe early. Access to these deals requires enormous capital and connections, both of which a family office naturally has. In the end, while investing is often portrayed as the road to wealth, for the rich it's more about preserving and growing what they already have. The strategies they use, from basic blue-chip investing all the way to complex tax maneuvers and private equity deals, show just how different their playbook is from the average investors. The more wealth you have, the more tools and opportunities are available, and those tools can make a dramatic difference in outcomes over time.